1031 exchanges are the key to deferring and potentially eliminating your real estate taxes. They are a cheat code to building wealth. It's Aaron from 1031 Specialists, and in this video, I'm going to show you how. Did you know that U.S. taxpayers are subject to as many as 4 layers of tax when selling an investment property? Most are aware of the first one, federal capital gains tax, but many are surprised to learn about the other taxes. When you sell a property, you can be subject to, first of all, the federal capital gains taxes, which can actually be between 15 to 20%, depending on the tax bracket. Number 2, state taxes. These can vary anywhere from 0% in some states all the way up to 13.3% in California. Number 3 are investment income taxes. This can be 3.8% if applicable, depending on the tax bracket of the investor. Number 4 is depreciation recapture taxes. This is 25% of all that you've depreciated through the years. These 4 layers of tax can add up to nearly 40% of your investment gains. A 1031 exchange allows you to defer all of these taxes. By keeping more money in your pocket, you can purchase more property and compound your wealth at a far higher rate than if you pay taxes each time. The true power of a 1031 exchange is the ability to meet your investment objectives without losing equity to taxation. Here's an example. Let's say you're selling a rental property that you've had for a few years, and you're excited to pocket $200,000 in profit from the sale. Now, everything seems good until the following year when you have to report the sale on your tax return. This is when the shock sets in, when you find out you have to write out a check to the IRS of up to $80,000. So hopefully you haven't spent that money yet. With a 1031 exchange, you keep that equity, and that extra equity you keep allows you to buy larger, multiple, or more productive properties. If it's a property with more equity that has been depreciated, the tax hit will be even much larger. So a $2 million property with very low tax basis could trigger an $800,000 tax bill the following year when it's reported to the IRS. All of this can be avoided with proper planning and a 1031 exchange. As you can see, there's a lot of benefit to doing just one 1031. But what if you do multiple 1031 exchanges during your lifetime and you keep on exchanging? This table demonstrates the impact of taxes on compounding. The same transactions, the same returns each time, 50% return on equity. The only difference between the middle column and the right column is deciding to do a 1031 versus not doing one. If you do 10 1031s in your career, you will have turned $100,000 of equity into $5.766 million. If you decide not to utilize a 1031 and pay 30% taxes each time, after 10 transactions, you'll take home just north of $2 million. So you'll be $3.75 million richer by doing a 1031 exchange each time. But what if you did 20 transactions in your career? As you can see in the dark gray box at the bottom, you'll be $292 million richer by choosing to utilize a 1031 exchange versus not doing a 1031 exchange. This is the power of tax-free compounding. This is the magic of 1031s. There is no limit to the number of times you can 1031. That's why 1031 old-timers just keep exchanging. While you're alive, 1031 exchanges allow you to buy property with higher basis, benefit from more bonus depreciation, and build a larger real estate portfolio that generates more cash flow. And when you pass away and your heirs inherit your portfolio, they'll get a step up in basis and won't pay a dime on the lifetime of appreciation you made happen. You will have avoided taxes altogether. This is what we mean by swap till you drop. There are even more benefits to exchanging that I haven't mentioned yet. 1031 exchanges offer investors the following opportunities. They can consolidate into fewer properties. They can diversify into multiple properties, which we see most of the time. They can use it for elimination or creation of joint ownership. It can help with relocation of an investment property or business. It also gives the opportunity to depreciate higher basis replacement property. And it gives the investor the ability to transition from active property management to passive mailbox money. So there are so many reasons investors should consider a 1031 exchange instead of selling. The better question is, why wouldn't you exchange? Up next, we'll cover the 5 commandments of 1031 exchanges. Whatever you need on 1031s, just ask. I'm Aaron at 1031specialist.com.